is a bit different, so I'll mention that as well.
Okay.
Yeah.
Good afternoon. Thank you for joining our second session from TSP. This session is live streaming, so all of DEA worldwide and nationwide has access to this presentation. If you are out in the field, the easiest way to access Mr. Robinson's presentation is to log on through the internet, not by Firebird. I heard Firebird was having some issues, so if you can log on through the internet. If you have questions, for those of you that are here in the auditorium, if you would wait so we could hand you a mic so our folks out in the field can hear your questions. If you would just wait. Also, there are evaluation forms, and all of the information will be downloaded into our website, and the presentation will also probably one day next week be downloaded. So I want to now turn it over to Damian Robinson from TSP.
Thank you, Phyllis, and good afternoon, everyone. For those of you who were here this morning, bear with me through the first half of the presentation. Some of the information is going to be the same information until the second half. And during the second half of the presentation, we're going to get into separated withdrawal options, which include the new withdrawal options that are going to be available in November 2019. So with that said, let me give you all some background on myself. I'm one of the 8 TSP trainers who travel throughout the nation, and we brief TSP participants. We offer 3 courses. This morning we did the early to mid-career course. We're doing the pre-separation, which is for those of you who are about 5 years or so away from retirement, but it's some good information for all federal employees in this presentation as well. Now, before I get into the agenda, if I could get a show of hands of anyone in the audience who may be separating or retiring from service prior to November 2019. Okay, so it's quite a few. Thank you all for sharing that information, and what I'll do for you all, you're going to have to go by the current rules initially, but once the new rules are implemented in November of 2019, you'll be able to take advantage of those new rules, which are going to offer a lot more flexibility, and I will go over those in much detail before we leave today, and I'll also stick around during a break and as well as after the presentation to answer any individual questions. So again, the FRTIB, the Federal Retirement Thrift Investment Board, we're located over in Northeast Washington, D.C. We're right behind Union Station, a very small agency. We have about a little less than 300 federal employees there. And again, 8 trainers that travel throughout the nation and answer the questions. We're kind of the face of TSP when it comes to all participants. So today's presentation, what we're going to talk about. Of course, we're going to talk about those new withdrawal options. We're going to talk about how to prepare for separation. We're going to talk about the retirement income options, what you can do with your money once you separate from service, purchasing an annuity, doing monthly payments, taking lump sum withdrawals, partial withdrawals, age-based withdrawals. We're also going to talk about how these new rules are going to change some of these considerations. We're going to discuss the TSP death benefits. We're going to have various retirement income scenarios for you all, and then we're going to wrap up with TSP resources. So preparing for separation. When it comes to federal employment, and I guess one more question I want to ask the audience before I get started. How many of us are civil service on the civil service retirement system? Okay, so quite a few. This is probably one of the larger groups with civil service retirement. So most of the information here is geared towards the FERS system, but it's not a lot of differences when it comes to TSP. The main differences is the FERS employees are receiving matching contributions where the civil service aren't receiving matching contributions. So I believe it's not going to be too much difference for you all throughout the presentation, but I'll be sure to point those differences out to you. So when we think of the components of retirement income when it comes to federal employees under FERS especially, it's 3 components there. We're going to have a Social Security benefit that's going to be there for us. Some under civil service may have the Social Security benefit as well if you had Social Security quarters before you came on board as a federal employee. And you're also going to have your pension, whether that be civil service or your FERS pension. And the bulk of the time today is going to be spent discussing the TSP. Now, with the other 2 components, again, I'm not the expert when it comes to Social Security or your FERS or civil service pension, but I want to give you some websites to get this information when it comes to those components. And I know that a lot of us have other resources when it comes to the components of retirement income. We may have rental income, We may have Roth IRAs out there, traditional IRAs. We may have taxable investment accounts, money market savings accounts, savings accounts. So all of these are streams of income that we're going to have once we retire. And the goal is to try to have as many streams of income as possible in retirement. So Social Security. So where should we get this information from? From what I've heard from Phyllis, you all are going to have a speaker on Social Security tomorrow, but I do want to share with you some of the best information available on the web. And of course, no better place to go than the source, which is SSA.gov. Now, on the SSA.gov website, in the upper right-hand corner, you're able to establish an account. So in that upper right-hand corner, it says My Account. I recommend if everyone has some time to just view this website. It's probably going to take 10 to 15 minutes out of your day to establish your Social Security account. But with this, you're going to get a wealth of information, some different scenarios, some different things to consider before claiming your Social Security benefit. It's going to go over the percentage increase that you are able to give yourself year after year by holding off on Social Security. Can anyone share with me in the audience other than Jack on what the percentage increase is from year to year for Social Security? Exactly, 8%. So that's a pretty good rate of return when you think about market-oriented investments, because although we can generate 8% returns in the market on a year-to-year base, usually it's not consistent. So usually it's more of an average than a year-after-year thing. But with Social Security, each year we hold off on Social Security all the way from 62 all the way to 70. We're giving ourselves an 8% increase. So that's a pretty good deal if we're able to hold off on that. So check out the SSA.gov website, establish your account there. And again, 10 to 15 minutes of your time would take all it would take to establish that account. Now, also on the SSA website, in the lower left-hand corner, they have what's called a retirement estimator calculator. And this is a neat, quick, fast, and easy calculator. And some of you may recall we used to receive the 2 to 3 page documents in the mail. And on the last page, it would show us what our benefits were at early Social Security at 62. Full Social Security, maybe 65, 66, or 67, and of course our maximum benefit at 70. So that 1 page, 2 to 3 page document is available on SSA.gov under the Retirement Estimator, and this will give you an idea of what your retirement benefit will be. Now, another website that I love when it comes to Social Security is the Consumer Finance Protection Bureau website, and that's CFPB.gov. And they also, well, if you type in CFPB.gov or you can type in consumerfinance.gov, they're both going to take you to the exact same place, which is again going to be the CFPB's website. Towards the lower right-hand corner on that website, they also have a retirement calculator, and this one is really user-friendly, and it's probably going to just take a couple of minutes out of your day to kind of do the Social Security scenarios, but they have a sliding scales calculator, and it's going to ask you for some basic information such as your date of birth and your last year's salary, and those are the only inputs. And from there, it's going to give you some guesstimates, estimates of what your Social Security benefit will be. And it will also show you from 62 to 63. It will show you that 8% increase in Social Security all the way to 70. So you could run some different scenarios. And it's also going to ask you some questions about your unique situation. Are you married? Would it make sense to claim half of your spouse's benefit if they're the higher income earner? It's going to go over some reasons on why you should delay or why you should claim early. So check out those couple of websites, SSA.gov and also consumerfinance.gov or CFPB.gov. Click on the retirement calculator. So when it comes to the pension, I do recommend that we take advantage of the resources that are readily available for us when it comes to our human resources specialists to come up with the printouts they can provide, especially as you're approaching retirement, to see what your benefit will be, whether you're under civil service or under the FERS system, to have an idea of what your fixed income sources are going to look like. Now, OPM.gov, when we visit their website, they do have some valuable information when it comes to calculating your pension as well. And in the middle of their webpage, it's going to be a link that says retirement. And once you click on that link that says retirement, it's going to take you to all of the calculations for not only FERS, but also for CSRS. So, of course, for the FERS employee, which is the majority in the audience, we have a pretty simple calculation. We have a 1% multiplier for the most part, and then we have our highest salary times our years in service, our high 3 salary in the years of service to kind of come up with that calculation for that benefit. So at the minimum for FERS employees, TSP, Social Security, and your pension will be components of your retirement income. So how much should we have in our TSP? So I like to back into this this ideal number a different way. I always like to let's take a look at what's guaranteed when it comes to fixed income in retirement. So again, for FERS employees, let's consider our Social Security benefit, and let's consider our FERS annuity and what dollar amounts those may be. And my background is in financial planning, so I've worked with clients in the past, so I have ideas of what these figures are. Of course, based on your salary and years of service, it's going to be different for each person. But let's say your Social Security benefit in retirement is going to be about $30,000. So Fitz number, $30,000 is going to be Social Security benefit. And let's say your FERS benefit is going to be about $20,000. So we're going to have a grand total of about $50,000 of fixed income in retirement. But let's say we were used to making about $100K before we separated from service. And maybe our goal is to be 100% replacement ratio. So we want to be at 100K in retirement. We're doing our earnings years, we're at 100K, and we don't want to give up anything in retirement. So what would we need to do to generate an additional $50,000 from our TSP? So it's a couple of rules out there, and these are all rules of thumb to kind of give you an idea of what you can generate from your TSP. And the first rule is called a replacement ratio. And in my first presentation, a lot of people in the audience had already heard of that replacement ratio. But what a replacement ratio says to you is, hey, out of your pre-retirement income, what amount will you need in retirement to be comfortable? And usually it's a percentage. So has anyone in the audience heard of a recommended percentage of what you would need in retirement based on your pre-retirement income? Any ideas? Any guesses? Let's say, do you need 10%, 20%? 70%, exactly. You hit it dead on the nose. It's actually a range. It's between 70 to 80%. So again, using my scenario, if the replacement ratio recommended is 70 to 80%, and you were making 100K before you separated, we would need about 70 to 80,000 to be comfortable in retirement. We already know that we have 50,000 using my scenario of guaranteed income. So how can we make up this $20,000 difference, or even this $50,000 difference, if you want to be made whole in retirement? So another rule of thumb in financial planning is called the 4% rule. And the 4% rule basically says that, hey, if you're taking withdrawals out of your portfolio no greater than 4%, that the money should be able to last you a lifetime. And we're spending a lot of years in retirement these days, 30 to 40 years. So hypothetically, let's say we were able to become a TSP millionaire, and we were able to grow this $1 million in our TSP accounts. Using that 4% rule, how much are we going to be able to take out of our TSP on an annual basis for the rest of our lives? 4% of $1 million. So $40,000. So getting back to that replacement ratio and our existing fixed income sources of $50,000, using that 4% rule, we're going to end up with about $90,000 of income. $50,000 coming from fixed sources and another $40,000 coming from our TSP if we were lucky enough to save that $1 million. Now, depending on the financial planner that you use, these rules of thumb may be a bit different, but for the most part, 4% has been the universal rule for a safe withdrawal rate. And basically all we're saying is, hey, in order for your portfolio to maintain itself, you have to at least generate a 4% return to support your safe withdrawal rate of 4%. And for the most part, that's pretty easy to do with a diversified portfolio. Now, for those of us who are invested in a G fund 100%, we may not be able to keep up with that 4% withdrawal rate. And I'm sure some G fund investors in the audience, and G fund is a great investment. It's a guaranteed investment. But when it comes to the rate of return, what has the G fund been generating, let's say, for the last 3 or 4 years? Anyone have any guesses? Exactly. It's somewhere in the 2% ballpark, usually between 2 to 3%. So if we're taking out 4% from our portfolio on an annual base to do that safe withdrawal rate, but our portfolio is only growing at the G fund rate, what's going to happen to our portfolio? It's going to deplete itself because it's going to go down in value. We're taking out more than it's growing, so you're going to have to diversify your portfolio. It doesn't necessarily mean that you have to get aggressive, but we're going to have to do something other than just a G fund by itself. And we have introduced these life cycle funds back in 2005. In the life cycle funds, we have a very conservative one called the L Income Fund. And the Life Cycle Income Fund is created for those in retirement who need to support themselves throughout retirement. So we've considered that consideration that money is going to be drawn down from the portfolio, but we're giving you enough stock exposure to give you a return that's hopefully going to outpace inflation. Yes, sir. Did you have a question over here? The L Income Fund. So the L Income Fund, which is the Life Cycle Income Fund. And I'll be sure to try to speak into this mic so you all can hear me. So that's one of the life cycle funds that we created to support those who are in retirement. And the previous course, we talked about a lot of the funds in more detail. This presentation, I'm not going to go into too much detail with the differences between all of our core funds and life cycle funds, but that L income fund is very important for you all to know, because that was created to solely support the fact that we understand that you're going to be making withdrawals from your portfolio in retirement. And that L income fund historically, and this isn't guaranteed, but it's been averaging somewhere between 5 to 6% since inception. So again, that supports that 4% safe withdrawal rule that I spoke about a little bit earlier. Now again, it's not guaranteed, so for some bad market years, of course, it's going to be less than that 5%, but overall, it has been supporting a safe withdrawal rate. Now, other considerations with that 4% rule that I talked to you all about, again, this is just a rule of thumb, but this is also going to allow you to leave some money to your beneficiaries. This is not going to deplete the account if we keep it in a moderate, diversified portfolio. So for those of you who say, hey, look, I want to spend all my money, and by the time that I pass away, nothing needs to be there, maybe you're going to increase your withdrawal rate a little bit higher. Because again, a 4% withdrawal is setting you up to leave your beneficiaries with something. So maybe 5, 6, 7% is going to allow you to be able to leave nothing to no one but yourself, and allow you to deplete the account throughout your lifetime. Now, again, we're talking rules of thumbs. To get some better ideas of how you're positioned for retirement, it's a couple of resources out there. One, I recommend that a lot of financial planners and different financial institutions, they use a software called Monte Carlo that runs 1,000 different scenarios on past and future market performances. That will give you more of a realistic idea of what retirement's going to look like for you. Or you can take advantage of a calculator we have available on the TSP website. And that calculator is called the ballpark estimate. How much should I save? And this calculator is going to ask you to bring a lot of information to the table, but it's a pretty powerful calculator. So some of the information you're going to need to bring to the table, of course, we need to know what system, retirement system you're under. So if you're FERS, we need to know that, because it's going to allow us to calculate those matching contributions. Civil service is going to help us calculate that pension. And we're also going to ask that you have an idea what your pension amounts are. So before coming to this ballpark estimate, be sure to visit SSA.gov and talk to your human resources specialist to get the FERS benefit, because we're going to ask that you input that into this ballpark estimate calculator. We're also going to need to know what your rate of return is going to be inside of your TSP account. And I know that may be a difficult question for some of our different life cycle funds and our core funds and mixes of funds, but where I would guide you all is to, we have an information booklet called the Fund Information Booklet. It's a booklet with a dark blue cover, and it goes over all of our funds, and it gives you the historic averages and the rates of return. Or you could visit our website, tsp.gov, and click on our investment funds, and it's going to show you the history of the rates of returns for all of our investments. So however you're invested, you're going to have to choose what rate of return it is, and it's going to have to be inputted into this calculator. And we're also going to need to know what percentage are you contributing, or what dollar amount, because we want to keep track of what you're doing now, and take consideration of the compounding interest and the share price appreciation on a ballpark estimate. Last but not least, two additional things you're going to have to input. You're going to have to estimate how long you would like this money to last. So again, how long are we going to live? No one knows the answer to that question, so just run some different scenarios, 20, 30, 40 years, to see if you're able to keep up. And the last, very important one, you have to give an idea of what you think you're going to need in addition to your FERS pension, in addition to Social Security, to support yourself monthly. So you may say, hey, I feel like I'm going to need an additional $2,000, or I need $3,000. You're going to have to input something there, and what that will allow us to do is give you a success rate. If you say, hey, I'm going to need an additional $2,000, we're going to say, well, you're probably going to be 90% successful to generate $2,000 based on all of the inputs that you provided. And we kind of use a Monte Carlo calculation in this system. It's not quite Monte Carlo, but it'll give you a more realistic. So these two tools, the rules of thumb that I shared with you all with the replacement ratios and a 4% safe withdrawal, along with a ballpark estimate, and again, if you're working with a financial planner, the Monte Carlo will let you know if you're on track for retirement or not. So when it comes to considerations for your contributions, we have to always keep track of what the annual limits are on the elective deferral, regular contributions, and also for our catch-up contributions in 2018. And normally what I've noticed is the IRS will release these numbers around the October timeframe each calendar year. So for this particular calendar year, the regular contributions, the elective deferral, the limit is $18,500. It increased by $500 from the previous year to last year. And for the catch-up contributions, the limits in 2018 is exactly $6,000. So if you're able to make contributions to both of those buckets, the grand total for 2018, you'll be able to contribute $24,500 if you're turning 50 within that calendar year for the catch-up contributions. Now, it is permissible to contribute the maximum amount over less than the full year, but one of the later slides, if you choose to do it that way, you may be missing out on some matching contributions, but you could definitely say, hey, I want to maximize the $18,500 in the first 2 months of the year, or you could stretch it out over a 6-month period, or you could do it over the course of the year. But just remember, if you're not doing it over the course of the year, you may be missing out on matching contributions, but you are able to go about it whichever way that you choose. Now, another thing that we touched on in the previous presentation is, as we retire as federal employees from federal service, lots of us will do something else in the civilian world, or we may do something part-time once we leave federal service. So keep in mind that the $18,500 elective deferral limit, it actually applies to a lot of different qualified plans. So you have to be careful with that, especially if you're going to separate or retire from service during the middle of a calendar year. And let's give a scenario. So let's say you contributed $18,500 before you left federal service, and you're going to work for a private corporation, and they have a 401k. Their limit is also $18,500, and that's the same $18,500 you've already maxed out with your TSP. So if you were to start making these contributions with your new employer right away, you're going to go over that limit, and you're going to have some penalties assessed by the IRS when it comes to exceeding it, or you're going to have to reach out to either your current employee or your previous employer, the federal government, and ask them to take some of those contributions out. So the Human Resources Office will not do those calculations for you, so make sure if that's something that you're considering, that you're keeping track of what you've already contributed into your TSP along with the new 401k plan. So let's talk about the contribution rules. So for FERS employees, we're going to opt you in for new and rehired employees at a 3% contribution rate. And you are able to opt out if you choose to. It's just a form that you're going to have to submit, and we'll reimburse the money back to you. But we do recommend, at least at a minimum, taking advantage of the 3% that we're opting in. And I always give federal employees 3 different goals. I always say, hey, first, let's make sure we're taking advantage of the maximum match. And the maximum match is 5%. It's actually 4% matching and 1% agency automatic for a grand total of 5%. So let's take advantage of that free money on the table. The next would be taking advantage of the IRS limit, the $18,500. And if you're turning 50 within that particular calendar year, I would give you another goal to take advantage of the $6,000 that you're able to do for the catch-up contributions as well. Now, when it comes to the contributions out of your pocket, the whole dollar amounts, you're able to do a whole dollar amount or any percentage as civilians. Military members are only able to do percentages as contributions to their TSP. So any money that you put into your TSP out of pocket, there is no vesting requirement. So the vesting is basically saying, hey, how much time do I have to do as a federal employee before I can keep all that's mine? And for most federal employees, that amount is, that time period is 3 years. So once you've completed 3 years, you're able to keep not only your contributions and those matching contributions, but you're able to keep that agency automatic contribution as well, that 1%. Now, if you were walking away from service, let's say 6 months or 1 year after the fact, you won't be able to keep the 1% from your agency, but you'll be able to keep everything else. So the agency contributions, which I just mentioned, 2 components, the agency automatic, which is 1%, always going to be there, even if you're not contributing anything, and also your matching contributions that allow you to go up to an additional 4% for a grand total of 5%. And again, no vesting associated with the matching contributions. So let's take a look at how the contributions go into your account. So let's take a look at the first row. So this is a federal employee who's decided that they're not going to invest anything in their TSP. So they're putting 0% in out of pocket. Their agency is still going to match them 1%. Since they're not putting anything in their TSP, they're not going to receive any matching contributions. So when we look at the grand total of someone contributing nothing to their TSP, they're still going to have 1% based on their base pay and their locality pay. So the first 3%, it works pretty easy. Let's go down to row 4 and look at the you put in 3%. So the first 3% matching contributions are matched dollar for dollar. So no tricks. It's very simple math there. So if you're putting in 3%, you're still getting 1% from your agency. You're going to receive an additional 3% in matching contributions. So you're going to have a grand total of 7% if you put in 3%. Now, the next 2%, they work a little bit differently. The next 2% is 50 cents to every dollar. So that's for 4 and 5. So if we drop down to row number 6 here, if we're putting 5% in out of pocket, our agency is going to go ahead and put 1% in. We're going to receive matching contributions of 4%. When we add those two together, we're at 5%. So we're going to have a grand total of 10%. Now, everything above 5%, we're not going to receive any additional matching contributions, but we're still building our retirement nest egg, and we're either giving ourselves a large tax deduction, or we're potentially giving ourselves the opportunity to grow some money tax-free if we're taking advantage of the Roth tax treatment. As mentioned previously, when it comes to the catch-up contributions, the calendar year in which a federal employee turns 50, they are allowed to start making this an additional $6,000 into their TSP account. Now, this is based on a calendar year, not on a birthday. So let's say your birthday falls on December 31st of 2018. You're able to start making your catch-up contributions January 1st of that calendar year. So it's based on the calendar year, not necessarily the day that you turn 50 years old. And this can be dollar amount only. We don't allow you to do percentages for the catch-up contributions. 2 ways to go about establishing your catch-up contributions. You can reach out to Human Resources, or you could go to the TSP website and download what's called a TSP-1-C. Again, the payroll system for DEA, I believe, is EPP. In the EPP, you're able to log into that system and set up your catch-up contributions as well as your elective deferral regular contributions. So with your catch-up contributions, we do require that you self-certify your intent to make regular contributions up to the IRS limit of $18,500. And the reason for that is the fact that we don't want you to miss out on any matching contributions. 2 studies we're doing at the headquarters right now. We're taking a look at what participants are doing when it comes to their TSP. We're looking at, are people making contributions to their catch-up and not making any regular contributions. And we saw that there are some employees out there. So we have to make sure we get this information out to all participants to make sure they're taking advantage of those regular contributions first, or they're doing them at the same time to make sure they're not leaving any matching contributions on the table. Again, catch-up contributions do not allow you to receive matching contributions. It's only your regular contributions that come along with those. Now, let's say over the course of the year, at the very beginning of the year, you self-certified and said, yes, I plan on maximizing my regular contributions, and I'm going to do my catch-up contributions at the same time. Let's say something happens throughout the year, and you're not able to maximize your regular contributions. We're not going to kick you out of the system or penalize you or anything. That self-certification is just for your benefit only, just to make sure that you're maximizing your matching contributions before doing your catch-up contributions. Yes, sir.
I was just curious, what are you catching up to with the name catch-up?
You know, sir, that's a great question, and I hear it at a lot of different forums. So the catch-up contributions is not saying to participants, hey, you're 50 years old or about to turn 50 years old. We knew you missed out on some contributions in the past. We're going to allow you to go back and make up for those contributions. Actually, it's not any of that. What the IRS is basically saying to us, we're getting closer to retirement. We're going to allow you to put a little bit more money away for your last few years in service or as an active employee. So it's just an additional amount you can do that calendar year in which you turn 50 years old, sir. It doesn't allow you to go back in time. It just allows you to make some additional contributions. See, we have one more question.
Okay, I have a question about the contribution. If I were to retire, say, after the first pay period of 2019, and I contributed $18,000 to my thrift plan in the first pay period, would the agency match 5% of that $18,000 or 5% of my? How does that work? Or my euro?
Yes, sir. So what happens with the matching contributions is based on your salary, your base pay plus your locality. So it's going to be 5% of your base pay in your locality. It won't be 5% of the $18,500. Have heard that question before. And the way, I guess the way I would look at that particular scenario is the system is set up as kind of a pay, earn as you go type system. So the incentive is to continue working over the course of the year and you're able to receive these matching contributions. So unfortunately, although you're doing a large lump sum all at once, you're not going to be receive all of those matching contributions all at once. It's only going to be 5% of base pay and locality pay. Okay. So for the catch-up contributions, again, no agency matching on catch-ups, and that's the one point I would like to leave you all with. When it comes to military members, do we have any in the reservists or retirees in the audience? Okay, we have a couple of folks. So let's touch on this for a bit. So for those of you who are reservists and still have active uniformed services TSP accounts, my pay system only allows you to do percentages. So you all aren't able to do dollar amounts in your uniformed services account as you are in your civilian accounts. Also, the uniformed services plays by a slightly different rule when it comes to how much money can go into the TSP. Now, this rule actually applies to all of us, but military members are able to utilize it a lot better than civilian employees. And that rule is called the annual additions rule, annual additions limit. And you'll see that on the bottom of this particular slide. The annual additions limit for 2018 is $55,000. So again, this rule applies to all federal employees and all 401k participants, TSP participants. And what it means to us is, I get a question lots, pretty often of, hey, does the matching contributions and that agency automatic contribution, does that go towards my $18,500? The answer is no. The matching and agency automatic contributions, they go towards another limit, which is called the annual additions limit. A lot of people don't know about it, but that's where our matching contributions and automatic contribution goes towards, and it goes to that $55,000 cap. As federal employees, civilians, most of us get nowhere close to that $55,000 because, again, the only thing we're able to contribute is maybe $24,500 if we're over the age of 50. But military members are able to take their bonus pay, and they're also able to take their hazardous duty pay and put it into their TSP as well, so they get a lot closer to that annual additions limit of $55,000. So here's a pretty important slide. This is a scenario of Ed and Susan, two federal employees, and they both make the exact same dollar amount. They're making $3,000 per pay period, and they're also contributing 30% of their pay into their TSP. So Ed has decided that he's going to contribute $900 per pay period, whereas Susan, on the other hand, has decided that she's going to do $712 per pay period. So all looks well all the way until pay period number 21. When we take a look at Ed, in pay period number 21, EPP has kicked him out of the payroll system. You know, again, he was started off doing $900, but if we look at pay period number 21, it reduces him down to $500 because if he were to do $900, he's going to go over the elective deferral regular contribution limit. So he's kicked out of the system in pay period number 21, which is okay. He was able to reach that $18,500, and he's received matching contributions of $2,520. But when we take a look at Susan, she went about it a little bit differently. She chose a different dollar amount. She chose to do $712 per pay period. And I'm guessing that Susan probably got this from one of two places. Either the human resources sent out an email towards the ending of the calendar year or very beginning of the calendar year. They said, hey, all federal employees under this agency, if you would like to maximize regular contributions, you need to contribute $712 per pay period. Or she did a little bit of homework herself and did some math and basically said, okay, I know there's going to be 26 pay periods this year, and I know the limit for 2018 is $18,500. So she did some math there, and she divided the $18,500 by the number of pay periods, and she came up with the $712. You know, again, with the catch-up contributions, she would do the same thing with the catch-up contributions as well. She would take that $6,000 and divide it by the number of pay periods, and that will let her know the number of the dollar amount per pay period to maximize the match as well as the IRS limit of $18,500. So again, in this scenario, Ed is kicked out of the system in pay period number 21. Susan still has room left. After pay period number 21, she's only contributed $14,952. So she has some room left before she maxes out. So when we take a look at the updated slide from pay periods number 21 to 26, she's able to continue to contribute, and she's going to end up receiving matching contributions for a grand total of $3,120 compared to Ed, who only received $2,520. So he left a little bit of free money on the table when he compares himself to Susan. Now, for those of you who aren't maximizing the IRS limit of $18,500, don't worry about this particular slide because it doesn't apply. As long as you're doing 5%, you're going to maximize your match. This is for someone who's not only maximizing their match, but they're also maximizing the IRS elective deferral regular contribution limit. This is how they would need to go about making contributions to their TSP. I have a question for you all. Would it be any reasons why it would make sense for Ed to kind of front load his TSP this way? Exactly. I heard it from several different people in the audience. Maybe Ed was going to retire early. and he doesn't plan on working a second job, so he's not worried about exceeding that $18,500 with another company. So his goal was to make sure he got $18,500 into his TSP account before he walks out the door from federal service, because he wants to make sure he gets that large tax deduction, and he also wants to build up that retirement nest egg. So that may be one of the reasons. I've heard other investors in my past that believe that, hey, investing early in the year is going to allow your money to compound a little bit faster than going over the course of the year where the market's down in the month of January. That hasn't been proven. You're allowed to contribute as much as you're able to at any point in time. But again, I can't say that a strategy of putting all of your money all in at once just because of market performance is going to lead the way. I haven't seen that confirmed. So let's talk about the TSP's expense. This is one of the most important things that separates the TSP from our civilian counterparts. So when it comes to TSP, extremely low cost. When I used to deal with clients in my past and I saw that they had TSP accounts, although I wanted them to use the investments I use as a financial planner, I told them to keep their money in the TSP because it's an extremely low cost plan, and I wouldn't want them to have higher fees when they didn't have to when they were already in a good plan. So again, for 2018, the cost is 33 cents per every $1,000. And that's pretty unique, because another question I get pretty often is this expense going to increase over time? I don't know the answer to that, but I will say last year, the expense was 38 cents per every $1,000. So we're saving a nickel this year. And we just opened up the TSP to not only civilian employees, but also the military members under the blended retirement system, which is a new retirement system for military members as of January 1st, 2018. So again, we're adding people to the TSP, but it doesn't seem that we're getting any more expensive. So for calendar year 2018, the only cost is 33 cents per every $1,000. So let's compare that to the civilian counterparts and private organizations. The average 401k is about $4.30 per every $1,000. And sometimes when you have an IRA and you're working with a planner or you're working with an investment company or a bank, I've seen those fees as high as anywhere from about $10 to $20 per every $1,000. And that's just one expense. What we're talking about right now is called the expense ratio. So TSP, very low cost. Some other expenses that you're going to run into, and it's about 4 of them. So again, we already talked about expense ratios, and they're always going to be there regardless of the type of investment you're in. But you may also have a sales charge. TSP doesn't have any sales charges. With sales charges, you're going to pay a percentage just to get your money into the account. I've seen it as high as about 5.75%. And if they don't get you on the front end, they can get you on the back end. So if you don't allow your money to stay in this investment for a certain amount of time, you may have a deferred sales charge on the way back out. So that's the second expense. The third expense is called a management fee. And a management fee is getting really popular these days. And I've seen those as low as about 1%. And I've seen them as high as about 3%. And with the management fees, they're charged to your account balance regardless of performance. So you could have a really bad year in your account, 10% negative return, and guess what? You're still going to be charged 3% if it's that high of a management fee, so you have a negative 13% return. So be aware of this. Now, is this a bad thing? Not necessarily, because we may need the expertise of the investment company or the planner. You just have to kind of weigh your odds and say, hey, can I do this myself, or do I need that expertise to help me out? And if you do need that expertise, maybe it's worth paying the additional fee. Now, the last expense is something that I see often. It's either called a custodial fee or a maintenance fee. And these I've seen as low as maybe $35 a year. I've seen it as high as $150 a year. And this is also a termination fee if you move an account out. And one of the things that we're going to talk about a bit later is, how can I get money that's in these 401ks or these traditional IRAs on the outside into my TSP to take advantage of this low cost that you're talking about? And I'll walk you through step by step with it. But before you do so, make sure you reach out to the old company and ask them, hey, are there any termination fees? Because it seems like it's a standard practice in the investment industry where there is going to be some type of closeout fee. So if it's not there, good for you. You're able to transfer it without any fees into the TSP. But be sure to ask those questions before you're moving any monies. So how do these costs affect the growth of your TSP? So here's a scenario here of someone starting with a $50,000 balance, and over a 30-year period, they've averaged a 6% annual rate of return, all else equal. And again, they're not making any additional contributions. So it's $50,000. You're going to let it sit for the next 30 years. When we compare the TSP to the 401k, it's going to be a big difference there. I mean, those few percentage points, those tenths of percentage points make a big difference. TSP, you would end up with $284,000 over that 30-year period. Compared to the 401k, you're only going to have $254,000, which is almost a $30,000 difference. So how can we get this money into TSP? So the best way to go about it is called a direct rollover. And a direct rollover, the burden isn't on the participant itself when it comes to the tax liability. And the reason for that is normally with a direct rollover, it's leaving one custodian and it's going to a new custodian. So again, it's leaving a 401k company and it's going to the TSP, which is going to receive the assets. So how can you get money into TSP? You're going to have to complete one or two forms. The first form is the TSP Sit 0, the SITSD. And the TSP SITSD is a really easy form. It's a one-page form. The top information is going to be your personal information. The second half of it is going to be the losing institution's information. We're just going to need the account number, the title of the account. Is it Roth? Is it traditional? And that's all we need. And you're going to have to send that to the company that's going to be sending us the assets. Now, you're also going to have to reach out to the losing company to see if they have any paperwork. So you're going to have to look at your statements and see what company manages those assets. Is it Fidelity? Is it New York Life? Is it another investment company? You're going to have to call them directly and say, hey, I'm moving my money from your plan over to my current plan, which is a TSP. And sometimes it's a bit hard. What I've noticed with the paperwork from the losing institution is it's a lot of paperwork. It's usually 30, maybe even 40 pages. But guess what? Only 3 to 4 pages need to be completed. It's just a lot of verbiage in there, and it's kind of intimidating, but it's worth the time to get your money into the TSP to take advantage of the low-cost offer here. So again, complete those 2 forms, get your money into the TSP, take advantage of the low cost of the TSP. And the types of accounts that can be transferred over. Sir, do you have a question back there? The Roth TSP?
If the funds in your 401 are jointly held, can you still roll them into your TSP?
So with 401ks, they can't be jointly held. It would have to be a non-qualified account to be jointly held. So we're looking at a classification known as any type of joint account would be what we call a taxable account. So if it's your name as well as your spouse's name, that can't be an IRA or a 401k or a 403b. So any of these accounts that are under the traditional TSP, those circles there, these are all called qualified accounts. Joint accounts happen to be unqualified accounts. So unfortunately, sir, you wouldn't be able to transfer that in. The other option that you all have, let me go over the classifications of qualified accounts. We have traditional IRAs. We have 401ks, which is the private sector's version of a TSP. We have a 457B, which is for state and local governments. And oh, by the way, if you happen to be leaving your civilian federal service and you're going over to local and state government, you're going to have some different rules to go by. This is the only account, one of the only accounts that allow you to make $18,500.
Go ahead, I just have a question.
Okay, this is one of the only accounts that is going to allow you to contribute $18,500 into your TSP and another $18,500 into your 457B. These other circles that I talk about, they're covered by the same elective deferral limit of $18,500. So 403Bs are for nonprofits. Lots of hospitals and teachers are allowed to contribute to 403Bs, and all of these accounts can be moved into your TSP. Yes, Phyllis.
Okay, I have a question from the Phoenix division. It says, when you retire, can you set up a monthly payment from TSP, or do you need to withdraw all monies and put into something else?
That's a lot of questions there. It's a lot of scenarios there. So let's see how to best answer that question. So when you separate from service, the way the rules are currently written, you're able to do 3 different things, and we're going to touch on these a little bit later, but you're able to do what's called a full withdrawal. And inside a full withdrawal, you're going to have the option to purchase an annuity. You're going to have an option to purchase you set up monthly payments, or you're also going to be able to do a lump sum transfer to an IRA or to your checking or savings account. So what I would say to that question is bear with me, because as we go through the presentation, I'm going to answer that question, and it's probably going to come out in 3 to 4 different scenarios. But you don't have to do anything with your TSP when you separate or retire from service. One of the options available for you is just to leave it where it is and allow it to continue to grow. Now, where she's going to be forced to do something is when she reaches the age of 70 and a half, and she's going to come up against her required minimum distribution. And with the required minimum distribution, The way to get around that under the current rules, and again, this is going to become more clear a little bit later in the presentation, but under the current rules, the way to bypass your required minimum distribution is to request monthly payments, either a dollar amount that you choose, or to choose monthly payments based on your life expectancy, which will meet your required minimum distribution exactly dead on the nose. Now, also kind of forecasting to that conversation, let's say you separate from service, and you've chosen to take out $1,000 per month in monthly payments, and your RMD requirement for the first year at 70.5 was $6,000. Using that scenario, you're going to receive $12,000 over the course of the year since you're receiving $1,000 per month. So you're going to meet your required minimum distribution, and you're going to exceed it, so you're not going to have to do anything additional. So that's what can happen with the monthly payments. You know, with the monthly payments based on life expectancy, whatever your your required minimum distribution requirement is, it's going to be met dead on with the life expectancy monthly payments. And Phyllis, I'm going to address it as I continue through the presentation as well. Yes, sir.
In terms of the transfer for direct rollover, is there a time limit or a deadline after which you can't do this, or can you do this even in retirement?
So with the direct rollovers, you're able to do it as often as you would like, sir. When you're in service or even when you're separated from service, we will always accept qualified plans as they listed here: traditional IRA, 401k, 457, and 403b. So anytime active or separated. Now let's go over to the other side of the coin here and look at the Roth TSP. So for those of you who have a traditional TSP and a Roth TSP, you're also able to roll over some Roth monies into your TSP. So as you all look at these circles here, one of those circles are missing. Does anyone notice what circle is missing there? Under the Roth TSP? One of the circles are missing. Traditional. So the Roth IRA option is missing, because when we look over at the traditional TSP, we see traditional IRA. But when we come to the Roth TSP side, we don't see Roth IRA. So one of the funny rules that IRS has is they don't allow the transfer of Roth IRAs into qualified plans to include TSP or 401ks, and that's unfortunate. Maybe they'll get, loosen up those rules somewhere later down the road. I'm not sure the reason for that, but that's one of the only accounts that can't be transferred into your Roth TSP as a Roth IRA. And to go one step further, if you all take a look at the comment towards the bottom of this particular slideshow, this particular slide, you cannot transfer rollover Roth, educational IRAs, which are also known as Coverdale IRAs, and or inherited IRAs into your TSP. But everything else, qualified plans, can come into the TSP. Yes, sir.
If you have Roth 401ks, or if you have Roth IRAs, can you first transfer them into a Roth TSP? Second, after separation, could you create a Roth TSP and transfer your Roth IRAs into that account?
So the Roth IRA, it can't be transferred into your Roth TSP, but it can go the other way around. And actually, it may make sense to do it. And I love TSP, and I want you all to bring as much money to the TSP as possible to take advantage of the low cost. But it actually may make sense once you separate or retire from service to take your Roth TSP and move it over into a Roth IRA. And the reason for that is because of the required minimum distribution rules. So with 401ks and your TSP, you're going to have a required minimum distribution requirement for both tax treatments, traditional and Roth. But guess what? A Roth IRA on the outside, it doesn't have a required minimum distribution requirement. So with a Roth IRA, you can grow your money forever. I used to work with clients, and I used to always share with them, your Roth IRA, if you have one, can be your most aggressive account because you can grow it forever. You never have to take money out of it. It has an unlimited time frame on it because the IRS is never going to knock on your door. But again, when it comes to that Roth TSP, when we turn 70 and a half, we're going to have to start taking money out of that as well as the traditional portion as well. So what I've seen some federal employees do, again, is unique to your own situation, is once they separate from service or once they retire from service, with the new rules in place, because the old rules are kind of different. And again, the new rules will be implemented in November 2019. But the new rules state, and I'm going to go over these in detail a bit later, but the new rules state that you can choose a tax treatment that you would like to withdraw from your account. So using the new rules, using the scenario that we're talking about now, you could say to us in November of 2019, hey, I want to take all of my Roth TSP money out, and I'm going to transfer it over to a Roth IRA. That way, when I turn 70 and a half, I don't have to take any money out of the account because I don't need it. I just want to continue to grow it. You know, with your traditional portion of your TSP, you're not going to be able to do anything with that one because traditional IRAs and traditional TSPs, they both have the required minimum distribution. But that Roth money, you may be able to get past it, again, when it comes to November 2019. Now, don't try to do it before November 2019 because under the current rules, we go by what's called pro rata. So if you were to request a withdrawal from your TSP account, it's going to come pro rata based on the percentages that you have in each tax treatment. So let's say you have 60% traditional, 40% in your Roth, and you do a withdrawal for $10,000, $6,000 is going to be traditional, $4,000 is going to be Roth. So November 2019, things are going to get a lot more flexible for you and are going to give you a bit more ease, and you're going to be able to be a little bit more creative when it comes to getting around some of these rules. But again, Roth IRAs can't go into TSP, but the TSP can go into a Roth IRA. And why would we do so? Again, the low expense ratio. So next we have what's called a indirect rollover. And I believe someone may have been thinking about an indirect rollover earlier. Now, indirect rollover isn't recommended, but sometimes it's needed. So with the indirect rollover, you are going to take the liability of the taxes yourself because you're going to receive a check made payable to you for an indirect rollover. And for an indirect rollover, on the paperwork that you receive from the losing institution, it's not going to have an option for indirect rollover. The only options is going to be there is a cash out, and a cash out is an indirect rollover. So basically what's going to happen with an indirect rollover, you're going to receive a check made payable to you. And guess what? If you receive a check made payable to you, what does that mean? You're going to be minus some taxes. So most plans do 20% mandatory federal taxes withholdings. So you're going to receive a check minus taxes, and you're going to have 60 days to get this money into a qualified plan such as a TSP. You're going to have to be careful with this because if you don't get it done within that 60-day period, it becomes a taxable event. And yes, I understand that we already withheld 20% for federal taxes, but most people are in higher tax brackets than 20%. So you may owe some additional taxes on top of that 20%. And if you're under the age of 59 and a half, you may also have a 10% early withdrawal penalty. So be careful with the indirect rollover and trying to get it into the new account within the 60-day period. And another consideration is the fact that if it's a taxable event, it's going to raise your taxable income, so you may be in a higher tax bracket. And I always see maybe two different reasons on why people do indirect rollovers. Number one is just based on the fact that they made a mistake. And most companies will work with you if you make a mistake. They'll just ask that you resend the check to them, and they'll reissue you a new check, or they'll ask you to void the check, and they'll resend you a new check. Mistakes are made. Most companies will work with you. The other reason is, you know, the person has a game plan. They're thinking that, hey, I have 60 days to pay off some credit card debt, or I'm going to pay off a car loan, and I'm expecting to receive some money. My leave balance is going to be paid off, and I'm going to be able to repay this money back. So usually you have a plan like that, or maybe you're thinking, hey, I'm going to take this check, I'm going to go to the casino, I'm going to double my money, I'm going to keep some money for myself, and then send the rest. So one or two reasons, but I don't recommend the indirect rollover. If you can go with the direct rollover, you're going to be better off with that scenario because, again, it's the less possibility of you running into a taxable event. So for those of my the military members or who've had military service in the audience, let's talk about combining your TSP accounts. And Phyllis and I had a talk about this during the lunch break on, you know, does it make sense to combine those accounts if you have a civilian and a military account? And it really depends on the scenario. You know, if you have a military account and you did some, let's say, some hardship time or some hazardous duty time, and you have what's called tax-exempt money into your account, you won't be able to transfer that tax-exempt money into your civilian account. Everything else can come over to your civilian account except for that tax-exempt money. But when would it make sense to combine the accounts? When wouldn't it make sense to combine the accounts? If you feel that you have both of these accounts, your civilian and your uniformed services, and you're thinking that, hey, I may need to touch some money prior to retirement or prior to separating, You may want to leave them separate because with an active account, you don't have as many withdrawal options as you would have with a separated account. And especially with the new rules in place, we're going to allow you to take up to almost 12 partial withdrawals with the new rules, and you could take all of those out of your separated account. Whereas with your active account, you aren't able to take out withdrawals unless you're doing a hardship withdrawal, which has some very stiff penalties that I'm going to talk about in a couple slides down the road. Now, when does it make sense to combine the accounts? Let's say you want to take a larger loan amount. If you were to combine the accounts, of course, it's going to increase your dollar amount, so you're able to take out a larger loan and repay yourself back. But other than that, you may want to leave them separate, again, if you have a need for income, and maybe you just want to have two different investment strategies. Maybe one account is going to be your conservative account, and the other is going to be the more aggressive account. So that's for those of you with the both types of accounts, military as well as civilian. So we also have age-based withdrawals for all federal employees once they reach the age of 59 and a half. The minimum withdrawal amount is $1,000. The maximum amount is the entire vested amount. You're able to do a cash distribution to a checking or savings account, or you could transfer it over to an IRA. And you can continue to make contributions to your TSP. Since you're still an active federal employee, you're able to build it back up, but you'll be starting from scratch if you did a full transfer. Now, some reasons that I've seen people do age-based withdrawals in the past is, they are preparing for retirement. So maybe they're paying off some outstanding debts, credit card debts, or a mortgage. Be careful with a mortgage because it can bump you up into a higher tax bracket. Or maybe they're just looking for another investment option. The TSP is a great investment plan, but it's limited options. We only have 5 core funds, index funds, and we also have 5 or 6 life cycle funds. But when you look at the investment universe outside of TSP, it's thousands of different investments. You can invest in gold, you can invest in a sector, you can invest in finance, you can invest in Bitcoin, you can invest in anything on the outside. So some people just want to have more flexibility on their investment options, and sometimes they use the age-based withdrawals. They may be paying more money on the outside, but hey, they just want some more flexibility in what they can invest in. So let's talk about the options available once we separate from service. And Phyllis, before I get into this part of the presentation, we're right at an hour. This presentation is probably going to be wrapped up in another hour to hour and a half. Should we take a 10-minute break now?
Yes, let's take a quick 10-minute break. It is 2 o'clock. Let's be back at 2:10.
Now, stick around in case anyone has any questions.
And as soon as we get access to the video, that will be downloaded on our website, so all presentations will be available for review. seats.
Okay, everyone, we're going to jump into the retirement income options, and these are the options available for you once you separate from service. But I wanted to share with you, one of the gentlemen I spoke to on a break asked some good questions. He was asking about the management of the TSP and who chooses the investments inside the TSP. So we use a company known as BlackRock. They're one of the largest investment companies out there. And BlackRock, they manage our core funds, the C, the S, the I, and the F. Now, the G fund is kind of a unique investment, so that's it's not managed by BlackRock, but our other funds and our life cycle funds are all managed by BlackRock. But when it comes to picking and choosing the individual stocks, we don't have an analyst who is traveling to different companies and looking at balance sheets and choosing the individual stocks or bonds inside of the portfolio. We're using trust funds, which are very similar to mutual funds, and these are collections of stocks and bonds. So when you look at the C, the S, and the I, these are stock funds. And inside of these stock funds, they mimic an index. And the C fund, the index that it tracks is, does anyone know? Yes, sir, the S&P 500. So if you ever wanted to know what was inside the C fund, you're just going to Google the S&P 500, and you're going to see 500 of the largest U.S. companies in the United States. The S fund is smaller to medium-sized companies. The largest holding in the S fund right now is Tesla, to give you an idea what type of investments are there. The I fund is international companies, and they have a heavy concentration in an area known as the FE, and that stands for Europe, Australia, and the Far East. You also have the F fund, which is everything bonds. So if you're invested in the F fund, you're in corporate bonds, you're in treasury bonds, you're in mortgage-backed securities, you're in all things bonds. And if you wanted to see what type of bonds were in that F fund, you're going to Google a ticker symbol is AGG, Alpha Golf Golf, and you'll see all of the bonds and different types of bonds inside of that portfolio. And last but not least, we have the G fund, which isn't managed by BlackRock, but it's actually, it's not a make-believe fund, but what we do is we look at all short-term treasuries and treasuries with maturity dates of 4 years or less that are able to be purchased in the open market, and we take the average of those 4-year treasuries, and that's your G fund rate. And that's why it changes every month, because we do this recalculation of what these treasuries are averaging in the open market. So the G fund is the one that's actually not managed by BlackRock, but all of our other funds are managed by BlackRock. And again, we're not picking these individual stocks or bonds, we're just mimicking these indexes. So again, using the C fund, let's say out of those 500 companies that Google goes under, and what happens to your portfolio is Google will replace by whatever company comes up and replaces it as one of the largest 500 companies in the United States. So I wanted to share that information with you all just to give you an idea of how the investments are managed, how we keep it very low cost through this passive strategy where, again, we're just looking at a computer screen and seeing what companies make up these 500 companies. And if one leaves, another one will come in there. And that's what keeps our costs very low. And lots of investors, to include Warren Buffett, believe in passive investing strategies, and that's how we're able to keep the costs down. Any other questions about the investment funds, feel free to ask a question. But again, it won't be any slides in this presentation talking about investment strategies or the life cycle funds. And the life cycle income fund, which I mentioned in this presentation, since it's one of the funds that is used for a lot of retirees who are drawing down their portfolios, the bulk of that portfolio is a G fund. It's about 75% in a G, and the remaining 25% is divvied up between the rest of our core funds. And you'll be amazed that remaining 25% can make a huge difference between your investment return of the G fund compared to the L income fund. Okay. So let's talk about the TSP withdrawal options bill that became law in November 2017. So over the months, we give these presentations and we get feedback from participants, and we take this feedback and we keep a tally on it. We talk to the executive director and the leadership at the FRTIB, and we say, hey, this is what the participants want. So we took this proposal to the president's desk, and it was approved late last year, and it's going to offer federal employees more flexibility in retirement, a lot more flexibility in retirement. So let's go over the changes with these new rules. It's about 3 to 4 changes. The first change I've already mentioned was about tax treatment. choosing your tax treatment. Again, if you were to make a withdrawal prior to November 2019, it's going to come out pro rata. So whatever you have traditional and Roth is going to come out proportionately. 60% traditional, 40% Roth. Your distribution is going to be 60%, 40%. So in 2019, November, you're going to be able to choose which tax treatment. So again, maybe you want to leave your traditional money where it is and only take out your Roth money because you don't want to have any tax liability if you've met the qualification rules of 59 and a half and the account's been open for 5 years. So that's one rule change. Unfortunately, we're not changing the ability to come out requested funds. And I know some individuals will say, hey, I only want to come out of my G fund. I want to leave everything else alone. You won't have that flexibility just yet. We're giving it a look, so maybe the next time around you will be able to have that flexibility as well. But as of right now, it's only going to be the tax treatment that you're going to be able to choose. The second change is going to be on our most popular withdrawal option, which is the monthly payments. So the way the rules currently read is your monthly payments are only able to be changed during open season. So let's give you a scenario. Let's say you separate from service. And where are we at? We're in July. So let's say you separate from service in July. You're able to set up monthly payments right away. So let's say your monthly payments start in September, because normally it takes us 30 days before the code in our systems are updated to show that you're separated. So let's say your payments start in September for $1,000. Well, you're only allowed to make changes under the current rule during open season, which is October 1st through December 15th. And again, this changes only once per year. And with the current rules, you're only able to reduce it to $25. You can't stop it. So let's say you started off with these $1,000 payments when you separated from service because retirement is unknown, but you're doing a lot better than you thought you were doing. So you don't need these $1,000 payments anymore. You would have to reach out to us and we'll have you complete a form, but the minimum amount you could reduce it to is $25, the current rule. With the new rule, November 2019, you're going to be able to change your monthly payments as often as you would like, and you are also going to be able to stop it if you choose to. So you could say, hey, I don't need these payments anymore, turn it off, and we'll be able to turn it off for you. With the new rules, you're also going to be able to keep your monthly payments going, and maybe you need to make a partial withdrawal for Christmas time or to purchase a car. You're going to be able to keep your monthly payments going and still make a partial withdrawal with the new rules. So a lot more flexibility when it comes to the monthly payments. The other changes go along with our withdrawals for partial withdrawals and age-based withdrawals. I mentioned the age-based withdrawal in a previous slide, which becomes available for you at 59 and a half. You're only allowed one age-based withdrawal under the current rules. And oh, by the way, if you take that age-based withdrawal under the current rules, you won't have any partial withdrawals when you separate from service, because that counts as a partial withdrawal under the current rules. Under the new rules, that age-based withdrawal at 59 and a half, we're looking at about 4 withdrawals per calendar year. So a lot more flexibility once you turn 59 and a half if you wanted to take money out of your account while you're still an active federal employee. Now, when it comes to the partial withdrawals, the way the rules work right now, again, one partial withdrawal when you separate from service, and it may be none if you've already taken that age-based. But with the new rules, we're going to allow you to take a partial withdrawal every 30 days. So a lot more flexibility when it comes to getting your hands on your money. And those are the changes that are going to be made with TSP by November 2019. And I would say for you all that are separating prior to then, of course, you're going to have to go by the current non-flexible rules. But once the new rules are implemented, you can change up your withdrawals to what I just shared with the updated rules. So any questions with the updated withdrawal rules? What I'm going to talk about next is the current rules, and I'm also going to talk about the differences between the annuity options, and we'll move into death benefits after that. So what can we do with our TSP once we separate from service? So option number one is do nothing. You could leave your money where it's at and do a delayed withdrawal, and as long as you're leaving $200 in your TSP account, your TSP is going to stay with you for life. And I always share with people, because I know a lot of participants will say once they separate or they retire from service, they don't want to deal with the federal government anymore. I've heard that before. So they move their money over to an IRA and they deal with a financial advisor or another institution. But what they see when they make that change is these expenses are out there. So they may have a change of heart and want to move their money back into the TSP. So if you're thinking about moving money over to an IRA, I would say to you all to leave $200 in your TSP account. That way you can always move money back into TSP or come back to TSP, because anything less than $200, we're going to close out the account. We're going to send you a check and you won't be able to come back to TSP. So delayed withdrawal is an option. And if you're separated from service, of course, you won't be able to make any payroll contributions to your TSP anymore, but you're still able to transfer money into your TSP, meaning if you have that IRA out there, traditional IRA, or if you have that 401k because you went to work another job after you separated, you can always bring that back to TSP. And I see a lot of federal employees use their TSP as that consolidation account because they do plan on working other jobs once they go out. And once they finish these jobs, once they separate from service, they're just going to move it back into their TSP. So again, you don't have to do anything with your TSP. You're still allowed to do what we call interfund transfers, which allows you to change your investment mix with your existing money in your portfolio. So again, we allow you 2 interfund transfers per month unless you're going into the G fund. So after that second interfund transfer, we allow you more, but it has to go into the G fund. It's kind of like fleeing to safety. We allow you to flee to safety if you've already done those 2 transactions per month. And then it resets the next month where you're able to do 2 additional interfund transfers. So next we have the partial withdrawal. Again, not too flexible right now. It's not there if you've already taken an age base, and it's only one available if you haven't taken an age base under the current rules. But let's talk about the partial withdrawal. Again, you're able to take a partial withdrawal if you haven't taken that age base, and once you've separated from service. The minimum amount is $1,000 and the maximum is your entire vested balance to include matching contributions. Again, I've seen partial withdrawals used to pay off the mortgage, to pay off credit cards debt. Something that I saw a lot as a planner is a lot of participants would go to their local bank or their credit union, and they would open up a money market savings account IRA or a savings account IRA. And the reason that they're doing that is to give themselves more flexibility and more liquidity because, again, retirement is an unknown. So they want to be able to have the flexibility to go into that bank or credit union and withdraw money right away in an instant. Whereas the G fund, of course, is like a high-powered savings account. But if it sits with the TSP, it takes some processing time for us to get the money to you. Usually it's anywhere from about 7 to 10 business days. So some people, again, will move money out of their TSP into this money market savings account IRA or savings account IRA just so they can get hands on money really quickly just in case they need it once they go into retirement. Be sure if you're using this strategy to make sure it has IRA on the end, because if you open up a money market savings account or a savings account and you transfer this money, what's going to happen? It's going to be a taxable event. So make sure if you use this strategy to make sure it's going into a IRA. So the other option is a full withdrawal, which is going to disappear with the new rules. You're no longer going to be required to do a full withdrawal in November 2019 because we're going to have so much more flexibility for you. But with the current rules, the full withdrawal, you're able to do 3 different type of withdrawal options. The first is a single payment, which again people have used to transfer to an IRA, or they use it to go into their checking or savings account. You're able to purchase a life annuity. And if you purchase a life annuity through TSP, you're going to end your relationship with TSP, and you're going to establish a relationship with MetLife, who is the vendor for the annuities. And last but not least, the most popular option is the TSP monthly payments, which comes in 2 forms, which I'm going to talk about a bit later, which is the monthly payments based on a fixed amount that you choose, or you can choose monthly payments based on your life expectancy, which will fulfill your RMD or give you a little bit of spending cash over the course of a year. So the first, again, a single payment. Again, this could be a lump sum paid out to you, become a taxable event, or it can be transferred over to an IRA or another qualified plan such as a 401k. Any taxable amount not transferred will be taxed as income for the year of the withdrawal. Next, we have the annuity, and I want to spend some time with the annuities because I don't feel that we share a lot of information with the annuity. So I want to go into details with what makes sense for someone to purchase an annuity. So most federal employees, I would say this is the least popular option when it comes to all of the options available for you. And the reason for that is, as federal employees, we already have guaranteed income streams. We already have income streams that seem to act like an annuity, which is your FERS, your CSRS pension, and also Social Security. So we already have that guaranteed stream. An annuity is just giving you an additional guaranteed stream of income. An annuity is also transferring the risk from yourself to the insurance company. So you're basically not having to worry about the market volatility of the market anymore. So you don't have to worry about managing the C fund, the S fund, the I fund, because that's managed by the insurance company now. So they're giving you some peace of mind. They're taking your principal and they're saying to you that, hey, as long as you're living, you're going to have a payout for the rest of your life. Now, the actuaries at MetLife or any insurance company, of course, you're doing their math, and the simplest form of an annuity is going to be the single life level payment annuity. So if we look at that second block, single life level payment, it's always going to be the highest payout. And I want to give you all a scenario which may be off a bit because I'm just pulling some numbers out of the air. But let's say you were able to accumulate $500,000 in your TSP, and you're thinking that you want to purchase an annuity to get this guaranteed income stream, and you just don't want to deal with the market anymore in managing your account. So you turn this into a single life level payment. So basically, this is going to turn into a bet against you and the insurance company. So you're hoping that you're going to live as long as possible, and the insurance company is hoping that you pass away the day after they issue the contract. That's the most common, simplest form of a annuity, a single life level payment. And again, what happens in that scenario? Again, you put $500,000 in. They say, hey, we're going to pay you $3,000 per month for the rest of your life. If you live until 120 years old, you're going to get paid way more than $500,000. So you win in that scenario. But again, if you were to pass away a couple of weeks later or a month later, you can't name a beneficiary on a single life level payment. So in that example, the insurance company wins. So not many people choose a level payment single life. So let's talk about some more common options for those of you who do choose to purchase an annuity. And another question that I get asked a lot about the annuity is, how much does the annuity cost? What fee am I paying to purchase this annuity through MetLife? And it's not actually a fee associated with it. When you look at annuities, and the type of annuity that you're purchasing through MetLife is called a single premium immediate annuity, also known as a SPIA. And what happens is you're giving them all of this principal up front. So again, this scenario that I shared with all, you're giving them $500,000 up front. They're giving you $3,000 a month for the rest of your life. So they're going to take that $500,000 and invest it in other investment vehicles. Maybe they're going to put it in the bond market or something relatively safe, but they're going to make some money off of your principal all at one time. So that's how the insurance company are making money off of the annuity that you purchase. So let's talk about another option. So some of you who may choose an annuity may say, so how is this annuity going to keep up with inflation? You know, inflation historically has been averaging 3 to 4%, although it's been pretty low recently. You may want to choose the increasing payment option under the single life annuity. And what happens with that one, of course, you're going to start off with a lower amount. So again, $500,000 you put in, the single life was $3,000. With the increase in payments, they may start you off at $2,000 per month. And what's going to happen is every year, we're going to look at whatever the inflation rate is. MetLife will look at the inflation rate, and they're going to allow you to increase your payment by up to 3%. Some years it's going to be flat. Some years it's going to be 1%. Some years it may be 5%, where they're going to give you that 3%. So the increasing payment option is going to start off with a lower amount, but you are going to be able to adjust your payment based on the inflation rate. Now, a more popular option when it comes to the annuity is the cash refund. So the way the cash refund, again, these are additional features you can add to your annuity. The cash refund allows you to name a beneficiary. And when you name this beneficiary, what happens if you were to pass away before receiving any of your principal back, your beneficiary is going to get the remaining payment. Now, with that option, it's also going to reduce your payments, though. So again, you're not going to start off with $3,000. You're probably going to start off with maybe $2,700, and it's going to stay at $2,700 for the life of your annuity. But at least you have the peace of mind to know that, hey, if I pass away before I recoup my $500,000, my beneficiary will receive the remaining amount. So that's a more popular option. Now, if you live a long life and you've already recouped your $500,000, of course, if you pass away at that point, that's going to end the annuity contract. We also have a 10-year certain annuity. Now, this is an additional add-on. It works similar to the cash refund, but it's a little bit different. So the 10-year period certain gives you a safe withdrawal period of 10 years where you're able to name a beneficiary. So let's say after you separate from service, you purchase an annuity, you add the 10-year certain option, and you pass away after receiving payments for 5 years. So whoever you have named as a beneficiary is going to receive payments for an additional 5 years. After that 5 years is over with, that's going to end the annuity contract in that scenario. So we also have joint life with spouse, and joint life with other survivor. I believe we have a booklet. It's a light blue booklet that's called the Income Options After Separation. And if you all don't have that booklet, it's available on tsp.gov as well. But it walks you through all of these annuity options, and it defines what a insurable interest is. So in order to purchase a joint life with another survivor, it has to be an insurable interest there. So two options with joint life annuities. You have a 50% and you have a 100% payout. So with a 100% payout, of course, it's going to be reduced again. So you're not going to start off with as high of an amount as you would with a level payment single life. But let's say with your $500,000, you're being paid $2,100 a month with a 100% survivor benefit. If you were to pass away, your spouse or the other survivor is going to continue to receive that same dollar amount. With the 50% option, it works a little bit different, so be careful with the 50% option. If you choose a 50% option with an annuity, if you were to pass away as the participant, your spouse's amount will be reduced by 50%. But guess what? As a participant, if your spouse were to pass away, the annuity is still going to be reduced by 50%. So a lot of federal employees don't like that. They say, hey, this is my money. Why is it being reduced if my spouse passes away? But that's the way our annuities are set up through MetLife. So I would share with you all, especially when it comes to this annuity, do your research, do your diligence when it comes to going out to other annuity companies and seeing what they're offering you compared to what we're offering you at the TSP to make sure you're getting the most bang for your buck, especially when it comes to some complicated ins and outs of our contracts. Now, another calculator, if you all are considering an annuity, on our website we have what's called the Retirement Income Calculator, and it's tied into the MetLife database, and it gives you real-time data on all of these options. The only thing we need to know is how much you currently have in your TSP, what your current contribution rate is, and what your expected rate of return is, and we're going to project the amount of your TSP balance at the time of retirement. And it's going to give you outputs from MetLife to show you what the single life level payment annuity will be. It will show you what the increasing payment amount will be. It will show you the cash refund amount. So you're able to see this real time to help you make the decision on whether or not the annuity makes sense to you or not. Again, this is the least common option when it comes to full withdrawal options, but it is available for those who need guaranteed sources of income in retirement. So next we have the TSP monthly payments, which is the most popular option. And the TSP monthly payments can kind of act like an annuity, except for it's allowing you the liquidity and it's allowing you flexibility to reach out and touch your money. So with an annuity, once that contract is signed by MetLife and ourselves, it's a done deal. We can't change our mind later down the road and say 6 months later, hey, let me pull a portion out of the MetLife annuity. They're going to say, no, we have a signed contract. With your monthly payments, you're able to change your monthly payments. Again, it's going to become a lot more flexible in November 2019, and this is why federal employees tend to choose this option more so than any other option. So we have two options, the fixed dollar amount and based on life expectancy. So with the fixed dollar amount, this again is an amount chosen by the participant, and it has no ceiling on it. You could choose any dollar amount you would like to choose. Under the current rules, again, the minimum amount is $25, and it can only be changed on open season October 1st to December 15th. But again, we're about to get rid of it with the new rules in place because you're going to be able to change as often as you would like to change. Now, with the monthly payments, bear in mind that you do have to deal with the volatility of the market. So you may have to go into your portfolio and change things around to support your monthly payments. Now, the other option for monthly payments is based on life expectancy. And this is for someone who's 70 and a half, they separate from service, and they really don't need to touch income inside of their TSP, but they have to meet their IRS requirement and do the RMD, so they choose based on life expectancy. And the monthly payments based on life expectancy will give you the exact dollar amount over the course of 12 monthly payments to meet your required minimum distribution. Now, another way to meet your required minimum distribution under the current rules, especially if you don't need income, and especially if you're going to separate from service prior to November 2019, you can set up a regular monthly payment for the minimum amount, which is $25. So you're going to receive 12 payments of $25. At the end of the year, we're going to send you a 13th check, and it's going to be the difference between what you've already received and what was required by the IRS for your required minimum distribution. So So that's another way to meet your RMD under the current rules. With the new rules, it's going to be so flexible that we're just going to send you your RMD check. You don't even have to request your RMD check. Or you could say, hey, send it to me around my husband's birthday or my wife's birthday or at Christmas time. You're going to be able to request it whenever you would like to. Another question I get about the monthly payments based on life expectancy is, it sounds a lot like an annuity. The way I would separate the monthly payments based on life expectancy or compare and contrast the life expectancy compared to an annuity, with an annuity, it's going to be a fixed dollar amount for the rest of your life. It's never going to change. So again, if you start off with $1,000, you're going to end with $1,000 unless you choose the increase in payments based on inflation. With a life expectancy monthly payments, it's going to change every year because it's still in the market. So what the IRS does, they have a table called the Uniform Life Table and the Single Life Table. They're going to look at this distribution factor. They're going to look at your account balance. And every year, they're going to say December 31st of the previous year, based on this single life table, is the amount that you're going to have to take out based on life expectancy. So it's going to change every year. It's not going to remain the same amount as an annuity will be. It's going to eventually start decreasing unless, again, you just have a great investment portfolio and it's growing in value. And in that case, it's going to go up in value. But you'll see with the RMD payments, required minimum distribution payments, you'll see that it's going to be almost impossible to maintain the value of your account as you age. And you'll see this on the upcoming slide. So with the monthly payments, how can you go about changing your monthly payments? So you're going to complete a TSP 73, and this allows you to change from the dollar amount during open season. It also allows you to go from life expectancy to fixed dollar amount. You can't go the other way. You can't start off with fixed dollar amount and go to life expectancy, but you can go from life expectancy to fixed dollar amount only one time. And again, open season right now, October 1st through December 15th. We also have the TSP 78. So you're allowed to change your direct deposit, where the money is transferred to, and your tax withholdings as often as you would like. Again, we're going to have the TSP 78 to complete that process. And if you decide that you no longer want to play with the TSP, maybe you want a final single payment, or you're going to roll it all over to an IRA, the TSP 79 will stop your monthly payments and will give you one final single payment, and that'll end your relationship with the TSP. And when it comes to the full withdrawal, you are allowed to do a mixed withdrawal, which is a combination of all. So using this scenario, this person has decided they're going to do a one-time lump sum payment of 10% of their account balance. They're also going to purchase an annuity. And with the annuity, the minimum amount is $3,500. So this person is going to take 20% and purchase an annuity. And they're also going to do TSP monthly payments. And oh, by the way, in this particular example, they check the box towards the bottom that says compute my payments based on life expectancy. So they're going to be covering their RMD payments with this particular mixed withdrawal. So again, earlier in a couple slides earlier, I mentioned the retirement income calculator. For those of you considering the annuity, please check out this website because it's going to give you the exact figures that MetLife would pay you right now based on your existing account balance. And we even allow you to project what your balance will be when you separate from service. So what else should we consider as we prepare to separate from service? Required minimum distributions is the big consideration. It's for all participants aged 70.5 and separated, must receive and pay taxes on income from the TSP every year. Now, there is a caveat to that for those who decide to continue federal service beyond the years of 70.5. So we're just going to defer it until you separate from service. So lots of federal employees, once they turn 70.5, they may work until they're 80 or 85 or 90 years old. And what they're doing is deferring their RMD. As long as they're working, they don't have to take this money out of their account. We're going to defer it until April of the following year in which they separate from service. So for those of you who have these IRA accounts that sit outside of TSP, if you're 70.5 or coming up on 70.5, it may make sense to move the money into your TSP to avoid that required minimum distribution, especially if you think that you're going to work for a couple more years after 70.5. Now, your first RMD, yes, sir.
If you're over 70.5, you're required, and you're still working, the RMD is only based on, when you stop working, only based on 1 year. It's not cumulative. It doesn't go back.
No, sir. So the question was, do I have to go back and make up those missed RMDs since I was working, let's say 71, 72, and the answer is no for that. As long as you're working, It's going to be deferred, and what's going to happen is, let's say you separate at 75, your RMD is going to be based on the required minimum distribution for someone 75, which is a bit higher than someone at the age of 70 and a half. And pretty shortly, I'm going to show you all the uniform life table that comes up with these calculations for people who are required to make this distribution. So your first year RMD must be received by April 1st of the year following the year that you turn 70 and a half, and all subsequent RMDs must be received by December 31st every calendar year. So the first distribution year, again, you're going to have to make this request by 70 and a half. I'm sorry, by April 1st when you're 70 and a half, the year following that time in which you turn 70 and a half. If we haven't received instructions from you by March 1st of that calendar year, the year after you turn 70 and a half, we're going to go ahead and mail the first RMD payment to you, because we don't want you to be penalized by the IRS, and the RMD, a missed RMD, is one of the stiffest penalties that the IRS has. Does anyone know what the penalty is for missing your RMD payment? What's that, sir? It's 50%. I thought I heard someone mention it out there. That's a pretty hefty penalty. You know, can you imagine having $1 million account and your first year's RMD is $36,000 and you have to pay half of that in penalty? That's a lot of money. So we're going to help you out that first year. So if we don't receive instructions from you, we're going to go ahead and send you the check. And if we still don't hear anything from you by, let's see, I believe it's October, we're going to put your account into what's called an abandoned status. So we're going to move it out to current allocation. We're going to put it in a G fund, but it's not going to earn any interest, and it's going to be considered an abandoned account. And we're not going to take it out of that status until we hear back from you. In most instances, when we abandon an account, the participant has already passed away, and we just don't know just yet. Either the family hasn't notified us, or through our research, we haven't found out that that person is deceased, and that's why it sits in abandoned. Some people just go on long vacations and they miss their RMD once they separate from service. But those are the two considerations when it comes to the required minimum distribution. One thing I wanted to mention to you all, although you're allowed April 1st of the following year after you turn 70 and a half, it may not make sense for you to defer it till April 1st. And the reason why is you're going to have to take 2 RMDs out if you wait until April 1st of the following year. So you're going to have to take one out by April 1st, and then you're going to have to take your second year's RMD out by December 31st of that same calendar year. So some people say, hey, that's going to take me into a higher tax bracket. So let me just go ahead, as soon as I turn 70 and a half, I'm going to take it out by December 31st of that same calendar year. That way I don't have to worry about taking 2 RMDs within the same calendar year. So again, based on your own unique situation, but you do have the flexibility to take it out that same calendar year or defer it until April 1st for that first payment only. So this is a uniform life table. This is an IRS table which goes over the distribution periods and comes up with your RMD calculator. So again, you could Google this table under the IRS and it'll pull up for you. And this lets you know the exact amount that you need to take out for your RMD. So again, I've done the math for the first year, the 27.4. That's about 3.65%. So again, if you have $100,000 in your TSP, your first year's RMD is going to be $3,650. So with the distribution period, whatever your balance is, you're going to take your balance and divide it by the distribution period, and that'll let you know what your required minimum distribution is for that calendar year. And again, it starts off very slowly. Again, 3.65%. It goes up incrementally over the first 10 years or so. But once you start getting into your late 80s, it goes up substantially. It's almost exponentially. It goes up from like 4% all the way to 8%. So at that point, you're going to be forced to take money out of your TSP and deplete your account since you're taking out such a large chunk. Because if you're taking out 8% from your account, you're going to have to generate an 8% return just to keep up with the withdrawals. And that can be hard to do when it comes to a market-oriented investment. Once you reach 110, it goes down in value a little bit, but that's much later in life. Sir, did you have a question over there?
Yeah, you mentioned something about withdrawing funds, once every 30 days. Thank you. Depending upon what the law is going to change.
Yes, sir.
Well, let's say you automatically set up your own monthly amount yourself. You set it up, hey, I want this amount of money. And after the first 6 months, you decided you don't want to take out as much. Now, is there going to be a law that says that we can do that, or you have to wait once a year to do it?
So with the new rules, November 2019. When are you separating from service, sir? Okay, all right, so you'll be under the new rules. So with you, when you separate from service, using that scenario that you shared, that, hey, you separate and you decide to do a certain dollar amount that you're thinking is the right amount, but over the course of the year, you realize you don't need as much or you need a little bit more. With the new rules, you can do one or two things. You could leave your monthly payment where it is and just request a partial distribution to go along with it, or you could say, let's increase the amount. Or you could say, let's decrease the amount. You're going to have full flexibility once those new rules are implemented to do all of those options. Okay. So again, the uniform lifetime table available on the IRS website, and this is how we calculate your required minimum distribution. It's based on your previous year's account balance as of December 31st. So again, for this year, you would look back at your account balance for December 31st, 2017, and you would go down to the age that you're currently at, and you'll come up with a distribution period, and then you're going to divide your account balance by that distribution period, and you'll have your RMD amount. So investing after separation, I mentioned this a little bit earlier, but once you separate from service, you're still allowed to make the 2 interfund transfers or your existing balance, and you're still able to do G-fund transfers after that second one if you choose to. And again, the low cost, your market returns, depending on how you invest it, are going to be all beneficial for you. When it comes to the full withdrawal, we do recommend the TSP 70. We do recommend using our withdrawal wizard that's available online, because the #1 reason that we reject forms is they're not adding up to the 100% total. And by using the withdrawal wizard, you can't go wrong with this one. We're going to force you to be at 100% before you print off the form. So this is available online for you. When it comes to spouses' rights, if you have a balance in your TSP above $3,500, for those under FERS, we're going to require that you have a notarized spousal signature before you make any withdrawals out of your account. We do have exceptions to that. So if you have an exception, whereabouts unknown, or exceptional circumstances, you're going to complete a TSP 16 and a TSP Uniform Services 16 for military members. Now, with this form, it has to be exceptional because we do receive requests at the headquarters where it's my spouse went to the mall or she's on vacation, but it has to be a very legitimate reason where you can't get in contact with your spouse. Now, for those of you under the civil service, and I promise I wouldn't forget about the civil service retirements in the ordinance here, we don't require a spouse's signature for CSRS. Now, we do require that a document be mailed to your spouse. So you have 2 weeks to get out of town before the form gets to them, if you choose to not let them know about it. So under the current rules, we have the pro rata distribution rule. So what that means to basically all federal employees is, based on how you're allocated in your TSP, your distribution is going to come out proportional. So again, if you're invested in all of our funds, the G, the F, the C, the S, and the I, whatever percentages you have in those funds are going to come out in a smaller distribution. So again, if you're 10% in the G and you request a $10,000 distribution, you're going to have $1,000 come out from the G fund. So it's going to come out proportional based on your current allocation. If you don't want it to come out proportional, you may want to go into the system and go all in into a particular fund before you make the change. This particular slide here shows what happens when you take money out of the TSP and move it over to a traditional IRA or a Roth IRA on the outside. And a lot of federal employees will do so, especially under the current rules, because it's just not flexible enough for them. So what they're going to have to establish on the outside is they're going to have to create a traditional IRA or a traditional qualified plan, such as a 401k, and the same for a Roth IRA and a Roth qualified plan. So if you have that traditional and Roth balance in your TSP, you're going to have to establish 2 accounts before you move it to the outside. And when it's moved to the outside, the Roth money is going to go into the Roth account, traditional money is going to go into the traditional account. And again, I believe I mentioned with you all, with the Roth IRAs do not have a required minimum distribution requirement. So some federal employees will take their Roth TSP when they separate from service and move that over to a Roth IRA, so they don't have to take money out of it. Because again, if they leave it with TSP, they're going to have to take money out of both traditional and the Roth side of the house. So exceptions to the IRS 10% early withdrawal penalty. So this is a pretty important slide. So the magic number for all qualified accounts is 59.5. As long as you're 59.5, you avoid the 10% early withdrawal penalty. Now, as a federal employee, if we leave our accounts with TSP, the magic number we go by is 55. So as long as we separate from service or retire from service at the age of 55 or the calendar year in which we turn 55, we avoid the 10% early withdrawal penalty. So we can start taking out monthly payments or our partial withdrawals or our full withdrawals, and we won't be penalized at the age of 55. Of course, we may have some tax liability if we have some traditional money there, but we avoid the early 10% withdrawal penalty. So what if you were to separate from service at 52 or retire at 52, but let's say you just left your TSP account where it was and you touch it at 56. You start making withdrawals from your accounts at 56. What age would you go by, 59 and a half or 55? Yes, sir, 59 and a half. So be careful. It's based on the calendar year that you turn 55 and you're separating or retiring from service. So even if you retire early and leave it there until you're 56, you still have to go by the 59 and a half rule. So here's another scenario for you all. What if you separate from service at 58 and you take your TSP and you roll it into an IRA on the outside and you start taking money from your TSP? What age do you have to go by, 55 or 59 and a half? 59 and a half. The IRAs only play by the IRS rule of 59 and a half. Only qualified plans such as a TSP and a 401k go by that 55 number. So be careful if you're considering moving money on the outside to an IRA that you may have that 10% early withdrawal penalty. If you're 59 and a half, you don't have to worry about it at all. So how can you touch money if you separate from service early? Let's say you're not 55. So you have a couple of options. You can do monthly payments based on life expectancy, which we talked about earlier. And since the IRS understands that you're taking money out of your account and the goal is to deplete that account over your lifetime, they're going to say, okay, you don't have to worry about that 10% early withdrawal penalty. So at 48, 50, 52, you separate from service, you choose to do the life expectancy payments, you avoid the 10% early withdrawal penalty. Another option is purchasing an annuity. When you purchase an annuity, you're basically saying to the IRS, I'm going to spend all of this money over my lifetime. So they're also going to say, okay, don't worry about that 10% early withdrawal penalty. Domestic relations court orders because of death. Of course, because of death, it's not going to be the benefit to us, but our beneficiaries are going to be able to take that money out of their accounts without that early withdrawal penalty. From a beneficiary participant account, and we're going to talk about this in a couple of more slides, but if we name our spouse as a beneficiary, they're able to take money out of that BPA account that we're going to establish for them penalty-free. The last two, I recommend consulting with an enrolled agent who prepares taxes or a tax advisor or a financial planner to make sure you're entering the right information on your tax return, but you can also avoid the 10% early withdrawal penalty based on medical expenses and permanent disability. So let's wrap up with death benefits. We're almost finished here. So to start the process, you're going to have to complete, or our beneficiaries are going to have to complete what's known as a TSP-17. And that TSP-17 is going to get the ball rolling on paying out our TSP accounts to our beneficiaries. So one of the things that I recommend to all federal employees, and I believe Phyllis may have had these booklets out there, but it's a small brown booklet called Death Benefits. I recommend either to grab one of those from Phyllis or to go on our website and download one. I keep mine in a safety deposit box or leave it with someone you trust because it goes through the steps on how to access those funds for your beneficiary. Another important form is a TSP-3, which is available online, or you can give us a call and we'll send it out to you. And sometimes even your human resources officer has a TSP-3 available as well. The TSP-3 will supersede, a new TSP-3 will supersede whatever you have on file. So if you're not sure who you have on file, or you've recently got divorced and want to make sure you get the X off of the TSP account, complete a new TSP-3. Now, the TSP-3, if you don't have one on file, we're going to go by the statutory order of precedence. The statutory order of precedence is spouse, natural and adopted children, the parents, the estate, and then your next of kin. And if you don't like any of those people, be sure to complete a TSP-3 and name who you would like to have your money in the event of your death. So the death benefits update, we recently changed the website where you can view who's named your beneficiary online. However, you are not able to update it online. So you're going to have to print off the form. We have a wizard where you're able to input the data, but you're going to have to print it off and fax it to us or mail it to us, and we'll update your beneficiary. So spousal, if you name your spouse as a beneficiary in the event of our deaths, we're going to establish a BPA account, a beneficiary participant account, but it can only be for a spouse. If you name anyone other than your spouse, they won't be able to open this account. So the BPA account is going to be automatically invested in a life cycle fund to match your spouse's, the age in which they turn 62. So if they reach 62 closest to the life cycle 2030 to 2040, whichever year they're going to be closest to turning 62 is going to be the life cycle fund that they're going to be invested in. You know, with a BPA account, as we mentioned earlier, you're going to avoid the 10% early withdrawal penalty. So a lot of federal employees have the option, if they, let's say the spouse is a federal employee as well, and they inherit a deceased participant's account, they're going to have the option of combining the accounts with their own account or leaving it separate from their civilian account. Some people will leave them separate because, again, if you need to touch money, we recommend, and you're not 59 and a half, why not take it out of the BPA account since you don't have to worry about the 10% early withdrawal penalty? If you're over the age of 59 and a half, maybe it doesn't make a difference, but these are some considerations on whether to merge the two accounts together. Another consideration is based on how old your spouse was. You know, so say for instance, the deceased participant was younger than you were. So in that scenario, you probably are going to want to leave the BPA open because the BPA will allow you to take the RMD when your spouse turns 70 and a half. So if they were younger than you, you may be able to defer it for some more years since it's based on their age of reaching 70 and a half. Whereas with your civilian account, it's going to be based on your age at reaching 70 and a half. Now, the one downside of the beneficiary participant account is the fact that you're going to be able to name a beneficiary once you inherit that account, but the only payout option for that beneficiary is going to be a cash payout. So if you have a pretty substantial size account and you leave it to a beneficiary, that could bump them up into a very high tax bracket. So that would be one of the only downsides to open a beneficiary participant account. The other way around it is opening up an inherited IRA, which you're going to have to open up with an outside institution, which we'll talk about in a second. So when it comes to non-spouse beneficiaries, the only option they are going to have is to have it paid out as a single payment. So again, that could be a bad situation. So again, if we're naming our children, a friend, or a cousin, the only option they have is a lump sum cash out, or they could transfer it into an inherited IRA. So again, if they're using an inherited IRA, inherited IRAs offer more flexibility, even more so than the BPA account, because it allows you to do what's called a stretch rule, which allows you to take money out of the inherited IRA over a 5-year period, but it has to be depleted once that 5-year period is over. The other option is to do based on life expectancy. So again, for me, with my son, I recommended, hey, if I were to pass away, I want you to choose the inherited IRA over life expectancy. And with the life expectancy option, even my son, being early 20s, he's going to have to start taking out payments from the account right away. Although he's far from 70 and a half, he's going to have to start taking these RMD payments out right away, and it's going to be based on another table that the IRS has called the single life table. The other option with the inherited IRA, at any point you can say, hey, I want to take all of the money out of this inherited IRA, and at that point you can choose to face a tax liability and do what you choose with it. Of course, you're going to avoid the early 10% withdrawal fee. So we're wrapping up. Let's go over about 4 different scenarios, and then I'll stick around and answer any questions for you all. But let's look at Gary. So Gary is 70 years old. He's been retired and living comfortably on his civil service pension. He will soon be required to start receiving income from his TSP, but he would like to take only the required amount. What should Gary do in this scenario? It's a couple of options he could go about. How would he meet his required minimum distribution? He has no need for this income.
Scenario you said you could take $1,000 out a month and you guys send him the rest at the end.
Yep, so he hit it dead on. So the gentleman shared with us that he could start taking $1,000 monthly payments, and if after the 12th month, if that $12,000 doesn't meet his required minimum distribution, we're going to send him a 13th check automatically to make up his required minimum distribution. Now, another thing he could do is he could do the minimum amount, which is $25 under the current rule, because he just doesn't have a need for this income. So he could do $25 per month, and again, at the end of the year, we're going to send him that 13th check that's going to make up the difference of what he's received and what the required minimum distribution. And the third option he has is he could do monthly payments based on life expectancy, because monthly payments based on life expectancy is going to hit that RMD requirement dead on, and he won't have to do a 13th check because the 12 will total the RMD. Now, for those of you who are going to separate after November 2019, you won't have to worry about it because you're going to have full flexibility on choosing your RMD whenever you want it. So again, you could do it quarterly, you could do it semi-annually, you could not do anything, we'll send the check out to you. So more flexibility, but these are ways around it under the current rules. So let's take a look at Brenda. So Brenda is retiring at age 60. She believes her first pension and Social Security would support her retirement lifestyle if she could only eliminate her mortgage payments. So what options does she have available for herself? Great answer. So the gentleman shared that she could annuitize, and that way she'll have enough money to cover her her mortgage payment. Now, the only thing with the annuity option is the fact that she's losing all of that liquidity, so that may not be the best option. So a better option would be maybe doing a monthly payment to cover the mortgage amount. And that way she remains control of her asset, and she could do partial withdrawals at a later time. So I like the annuity answer, but I like the monthly payment option even better, monthly payments for the amount of the mortgage. And that way she wouldn't put herself in a very high tax bracket, because what I've seen some federal employees or clients period do is they want to pay off the mortgage. And sometimes that mortgage is $100,000, $200,000, and they're putting themselves in a very high tax bracket all at once. And not only are they putting themselves in a higher tax bracket, but to take $100,000 out of your TSP, you're going to have to account for taxes. So you're going to have to take even more money out of your account. So maybe doing the monthly payments makes more sense to cover the amount of the mortgage. Next, we have Barbara. So Barbara is retiring at age 66. She's not sure whether she will need income from the TSP to maintain her retirement lifestyle. So she's just uncertain of what retirement is going to look like for herself. She also has a young grandson, and she wants to help with education funding. What options are available for her? Great. And the second piece is what you shared, sir, is what I was looking for. So she could basically do what I shared with you all earlier about establishing a money market savings account IRA or a savings account IRA and take a lump sum of money and transfer it to this account. Let's say it's $40,000 or $50,000, and this would be her backup emergency savings account. And from that emergency savings account, since she's unsure of what retirement is going to look like, and if she has an emergency that comes up and she hasn't established emergency savings, she can go to the local bank or credit union and take money out of her account. Of course, when she takes it out, she's going to have a little bit of tax liability there, but she's have money that's liquid for her. Now, the other scenario was education funding. So once she makes that transfer over to that IRA, IRAs allow unlimited withdrawals. So she would be able to take maybe another portion of the money she's taken out and transfer it to a college savings plan, which is a 529 account, and she'll satisfy both of her concerns in retirement. So tips and resources: read your withdrawal booklets and tax notice. It's a light blue booklet. We're going to update that around October, November of 2019. Make sure your personal data is correct on the TSP website. We want to make sure you're receiving those matching contributions. Make sure your agency reports your separation to TSP, because it's going to take about 30 days before we receive that code, so we could take care of these withdrawal options for you. If you have a TSP loan, when you separate from service, you're going to have 90 days to pay off that TSP loan. After that 90 days, we're going to declare it as a taxable event, and it's going to be considered ordinary income. Now, if you're under the age of 59 and a half, you may also have a 10% early withdrawal penalty. So be careful with the TSP loans once you separate service. Now, I mentioned earlier in the presentation about the indirect rollover where you had 60 days. So you could still potentially get this money into IRA if you would like to, but be careful about those loans. Take advantage of our withdrawal wizards available on our website, and make sure you keep a copy of anything you print off for your records. Utilize our website, tsp.gov, to view account balances, quarterly and annual statements, to change your contribution allocation, which is your new money into the account, to change your old money, which is an interfund transfer. You can view your loan amounts and what withdrawals are available for you. You can create user IDs online, and this is what I do. I can't remember my account number, so I created a user ID, and with my user ID, I'm able to log into my account. And recently, we changed the website where you're able to request a web password instead of giving us a call, and I'm sending a PIN to you, which can take 2 weeks, 3 weeks before you're able to enter your account. We're also available on Facebook. We're on Twitter. We have about 24 different videos on TSP on our website. You can send us secured messages where you could go into detail on what it is you're concerned about. We try to get back to you within 24 to 48 hours. And all of our publications are available online as well. And I just wanted to thank you all for your time today. I'm going to stick around and answer any questions if you have any for me. But thank you and good luck on your separation, your pre-separation, your journey to retirement.
Thank you. Before you leave, we would just like to come on down here, okay? The Employee Benefits Unit's goal is to make sure that our employees are educated on your entitlements, because there's decisions that you have to make whether you're first coming in the door or you're getting ready to go out the door. So our goal is to make sure that we have presentations like this so you can make those sound decisions. And so we would just like to thank you for coming out and supporting our educational programs. And we would just like to give you this certificate of appreciation for coming out today. Wow. And we hope you will come back, and we thoroughly enjoyed it.
Thank you, Phyllis. Thank you, thank you. Can I say one thing?
Yeah, thank you.
I always wanted to be a DEA agent, so I'm an honorary DEA agent. Thank you, Phyllis.
Okay.
Hey, sir.